The Quantum Group USA, LLC in California, DBA Quantum Distribution and Insurance Services. Advisors are responsible for following all insurance, DOL, FINRA, SEC, broker-dealer, and compliance officer approval requirements prior to distributing this information to clients. Well, welcome back. This is another episode of More Market Insights, and the reason we call it More Market Insight is because our guest is Andy Moore. He's the Vice President of Advanced Planning and Portfolio Solutions here at Quantum, and he's also the Oracle of Scottsdale.
It's kind of new Oracle, Scottsdale.
Yeah, but I think that that's appropriate for you.
As we just talked about, Warren Buffett just retired, so
I can't think of a
big
better
shoes to fill. We can try.
We'll do our best. But with you, I want to talk about 2025 and then what's going on, to your mind, in 2026. So we had 2025 unusual in the fact that we've had 3 straight years of 15% plus growth. So that's kind of a surprise. We had rate cuts. From your perspective, what kind of mattered most for advisors and long-term investors last year?
I tried to, as we were preparing for this, come up with 3 or 4, isolated events.
Yeah.
But I think that as the year evolved, and you just touched on, we ended the year up over 15% for the 3rd straight year, which has only happened 4 times since 1950. So it's a rare event that we have this much bullishness in the markets on a move forward basis. But when you look at 2025 as a whole, right, we had Trump, the 47th president, gets inaugurated in January. April's Liberation Day, right? So he's going to tax and tariff everyone. It was literally the end of the world. We had calls from advisors, clients were panicking. Do I buy the fixed index annuity now? But then you look fast forward, literally 3 weeks, 4 weeks later, we had this V-shaped recovery. And you and I talked almost every month how when we talked to advisors or clients, they didn't believe in the rally. We had at one point, it was 7 straight up months in the market, even through the summer doldrums, August, September, October, which are typically the worst months. Markets were still pushing higher. So when you look at how we started the year and then finished the year, I don't think anyone expected it. And even when we went back to January 25, when we're talking about market expectations, really from Wall Street, right? We had kind of a wide range of best guesses. 7,000, 7,200 was kind of the high. Ended at 6,850 or somewhere around there. But then we also had the quote unquote experts, looking for 10, 15, 20% corrections. They both were right? We had a 20% pullback in April, ended up 15% for the year. And you look at some of the triggers that was the cause of that, the AI boom is still, front and center. And ironically, we're filming this on Tuesday, I think it's Tuesday, but the market is off to a great start here to 2026. We're at 1.5% already. The Dow and the S&P hitting new highs. NASDAQ is actually lagging a little bit, but when you look at that AI boom, we talked about valuations throughout the year. It's still not expensive compared to the dot-com bubble, right?
Yeah.
And then we had the Federal Reserve actually helping the market, especially on the short-term end, cutting rates in the back half of the year. So that contributed to the V-shaped rally and, the most hated bull market I think I've ever witnessed since the early 90s, as long as I've been in business.
Yeah, and so, talking about the fundamentals now too, so we had all this political noise and all that stuff, and the fundamentals really didn't kind of make sense to what we were seeing. So going forward, how should advisors sort of explain to clients, what's going on without encouraging performance chasing or overconfidence? Because we still have to be careful here, even though we're seeing, I think we're seeing more bulls than bears than we saw like maybe 3 months ago.
Yeah, that pendulum has definitely switched. We always talk about investor sentiment.
Right.
And we had, for most of the year, it was bearish, when we talked about what investors actually thought of the market. And then actually going into year end, we get this bullish sentiment, and Santa Claus rally kind of failed a little bit this year. But let's go back to kind of 2025 and what worked for us as a company and an industry at Quantum, right? We deal in the guarantees in the marketplace. With the rates still elevated, we always look at the 10-year treasury. We were 4 to 5% range bound all year. That helped with all of our bonus products, so our cash up front. anywhere from 11 to 22%, depending on the product throughout the year. The higher income that was guaranteed for the retirees. So it was really, when we looked at 24 and 25, we kind of coined it refinance your annuity or refinance your retirement. I think that still holds true to a move forward basis, because I still think we're range bound on the 10-year. But from an advisor perspective, I really think as we get into early 2026, 3 straight years of over 15% returns, I really think the advisors need to take advantage of the bonuses in the marketplace. So we've talked about, I think it was third quarter last year, we wrote S&P 8,000. You and the marketing team did a really good job. I put some notes on a piece of paper, and it was probably our most requested white paper of the year. And the idea is to take whether it's a 13% or 20% bonus, and sell some of these asset classes higher now. So if we have 3 straight years of up 15%, you get another 20% right now. I would take that and start to de-risk the portfolio. I personally think when you look at all the pundits, S&P guesses are 75, 7,700. I don't see too many bears out there, which makes me a little nervous, right? Everyone is now on the bandwagon that the markets are going higher. I wouldn't be surprised to see a 20, 30% pullback sometime spring, summertime into the fall. Because if you look at catalysts for 2026, we still have a government shutdown potentially. In 25, we had the longest one in the history of our marketplace. End of January, maybe another government shutdown. A new Fed chairman's coming in. What's that mean for rates? Maybe another 100 basis points, because they're going to be pro-economy, pro-Trump is probably who he nominates there. You have the geopolitical issues that are out there. Venezuela, right? We just captured the president, and he's sitting in New York City right now. Is Cuba, Greenland, what's next on kind of the Trump agenda. But I think the biggest catalyst, and why I think you see a good-sized correction mid-year, is the midterm elections and how that's going to turn out. Markets do not like uncertainty, so I think you'll see some de-risking of the models, the portfolios from asset managers, which leads kind of at the correction. And at the end of the day, come November, maybe you see that year-end rip where we can get another 5 to 7, 8, 10% by year-end that's out there. But looking at the kind of the quantum in our position, and we were talking about refi your retirement or refi. I think it's enhance it now. If your clients have been in the market and they're pre-retirees or just retired, you worry about sequence of returns. Take those bonus products, take the big income products right now, guarantee that income, and instead of let's look at what we had to buy 3-4 years ago and get better terms, better rates today. Now let's enhance that retirement and take advantage of the higher rates, the better products that are in the marketplace that are out there, and let's enhance retirement in 2026.
Benchmark outperformance has been kind of tough, over the last 3 years, and you always talk about, you advocate for simpler designs, simpler index designs, and I think we're moving in that direction because at Quantum we spend a lot of time, we pay attention to how these products are designed. But comment on that, how does that look going forward?
So for 3 straight years now, as we talk about the returns, it's been AI-driven, growth-oriented. We talk about Mag 7 all the time, over 40% of the S&P weight. The benchmarks, the S&Ps, the NASDAQs, the EFA, your large cap growth stocks over in Europe, Asia, and the Far East, that was the number 1 performing index in the marketplace. So those caps and par rates outperformed the volatility control indices. There were still a handful of volatility control indices that did okay this year, but for the most part, flat. And we talked about the Federal Reserve cutting rates will help the vol control indices, but they're more of a value tilt multi-asset. You still have to have some of those benchmarks in your asset allocation reports on a move forward basis. But I do think as the market kind of rotates and you're starting to see a little bit more of the value tilt come back into play, that the vol control indices still have a place and deserve a place in the overall asset allocation inside the fixed index annuity and index universal life products. But don't get away from the benchmarks. We never know what's going to happen, and it's good to have an allocation of 20, 30% or whatever that may be inside the benchmarks.
See why we call him the Oracle of Scottsdale? We talk about the 10-year Treasury, which it might stay range bound. So what does that mean for income? What does that mean for growth and protection, for consumers and investors?
So I think that's that 2026 theme, enhance your retirement. I think you've got time this year. While the Fed has lowered interest rates, we get questions a lot of times from advisors that are new to the business who are getting asked by their clients, the Fed's lowering rates, how come mortgage rates haven't come down?
Right.
Or the 10 or 30-year treasury? The Fed doesn't dictate that, right? That's a supply and demand issue from what people think are the smartest traders in the world, and that's the bond market. So I do think the yield curve steepens. If we get another 50, 100 basis point cut in the Fed funds rate, that helps overnight lending, which I think there's $18 trillion in short-term money markets or whatever that number is. But it's not necessarily going to affect the longer term with a lot of the geopolitical risk that is out there. I think we're range bound 3 3/4 to maybe 4.5, 4 3/4 for the year. So what that means for us is we have time to enhance that retirement for the retirees and the pre-retirees. The advisors will have rate increases and rate decreases, but we'll be able to, I think this year, help the advisor, help the retiree enhance their retirement, whether that's guaranteed income, selling asset classes 20% higher. Our biggest probably year-over-year increase in product was one that has a 20% bonus, but 10% free partial withdrawal original premium. So I had a call yesterday. It's a few $1 million ticket. They're going to take the 20% bonus in anticipation of moving a couple $100,000 back into the AUM sometime this year when the market pulls back. So those are the opportunities. We're always on the assumption at Quantum of doing what's right for the end user. If we're able to show an advisor the right product, the right solution, the better enhancement for their retirement, that's just good business for everybody.
And with the the end user in mind too, we have some new technology that advisors can use to do a better job with their clients. Can you talk about some of the things that have been implemented here recently?
I would say this without showing our hands so far. We get asked all the time to either vet new technology, new software. I've probably played with most everything that's out there. And we're pretty agnostic to what advisors will use, whether that's planning software, the eMoney, Money Guide Pros, Right Capital, Retirement Analyzer. We've got partnerships with the online do-it-yourself, legal stuff, your wills, trusts, powers of attorney, things of that nature. But at Quantum, being more of a business development, integrated marketing, lead gen, type of an organization, advanced planning, when we see a need or a necessity, we'll go and build it ourselves. So we've got probably about a half a dozen projects going on. I think we'll see a new income tool launched sometime first quarter. We talked about refi your retirement. We're working on technology that'll go onto our advisor HQ that the advisors, so we get asked all the time about data feeds and integration, where an advisor will be able to see his whole book of business. Our VPs and our case design teams will be able to see that and make recommendations on policies that maybe come and due in the next 30, 60, 90 days. And then we're working on a couple other more advanced platforms that'll show sequence of returns, guaranteed income, non-guaranteed income. So we're working on a bunch of different projects out there that I think we'll launch probably 3 to 5 different technologies in 2026 to enhance the advisor experience.
And you mentioned marketing and lead generation. My partner, Lita Patrick, who is the Vice President of Marketing, and I kind of help, with all that on the other side of the building. We get asked all the time, a lot of questions about, what's the best way to approach marketing from an advisor standpoint? Because again, advisors typically aren't marketers, right? And, there's some fundamentals that we believe here in marketing. But some of the things that we constantly get asked about is AI.
I would say not just you guys, but our VPs, our business development directors, myself personally, when I'm working advanced planning cases or portfolio solutions, they always are asking, how's Quantum going to integrate, develop the AI portion of it? So with you and Lita and team's expertise, I'd like to know what you guys are doing.
Yeah, I mean, AI is obviously something that's very powerful. As you see now with the Venezuelan capture of Maduro, a lot of the video you're seeing is AI, and you can't really tell. So it's really interesting that.
You mean that's fake?
Yeah, that's fake.
Oh, okay.
Much of it is, but the hard part is to telling what's real, right? But from a marketing standpoint, lead generation standpoint, product standpoint, AI has gotten really good at helping advisory firms streamline operations. So for an example, nurturing, but still, this is a relationship business. It's gotten really good at identifying an audience. We know more about, for example, an audience in a market than probably the audience knows about themselves. So that's great. So we can kind of really be very, very good at identifying who's an ideal client, who's a prospect, who's likely to make, these decisions at this time. The hard part is, how do we reach them? We know who they are. It's the same problem we've always had, right? And so we have to be careful that, again, this is a relationship business, and the more AI, the more automation that you enter into a process, the farther you get away from that relationship, because that's still what we're in. This is not a transactional kind of a business. In some ways it can be, depending on the solution, but still the things that I think that matter most right now, especially now because how everything is so competitive as an advisory firm. Again, I say this day in and day out, that consumers cannot tell them apart. That's the problem. I mean, you've got a bunch of people out there, enormous amount of services and skills, but they're all saying the same thing. So the most important part is, how do you differentiate yourself in the marketplace and still maintain these emotional conversations, which are really the ones that are going to get people to work with you.
And advisors have pros and cons, right? Some can sit in front of a camera, some can do public speaking, some are really good on radio, rinse and repeat. What worked from our integrated marketing and client acquisition side of the shop in 2025, and is that still going to be the same on a move forward in 2026? Is there other partnerships that you may have discovered maybe fourth quarter that we're going to roll out? Tell us, how that looks going into next year.
Well, and again too, from from a marketing and branding standpoint, there's a lot of things that we've implemented here. We're using tools now, for example, that we can look at a market and find out what boomers are searching for online related to what we do in financial services. Now we can tailor content to those kinds of questions. AI right now, going back to AI, a lot of people are now moving from Google to ChatGPT. ChatGPT loves questions that have answers, so we've actually adjusted the way that we distribute content to make sure that a lot of times it's titled as a question. For example, will I have enough money in retirement, or something like that, with an answer, and that does help show up in search. And we're using a lot of video content. One of the things that and this is something that we've been doing all along, but now in this 4,000 square foot video platform that we have here, creating profile type content for advisors where they don't spend all their time talking about their services, but who they work with. How can they differ? How are they different? What's it like to work with you? What do you do for your clients? That's more important than I'm a fiduciary, because they don't know what that means. They know it's important, but they don't know what it means. They can't spell holistic. I mean, I'm not saying people are dumb out there, but they're just not thinking in those terms. So it's more important from an emotional standpoint. But video, our marketing department handles all the social media content, the business content. We are creating the newsletters and everything like that, and everything that we do is custom. That's the most important thing. There are so many other companies out there and tools that allow an advisor to pretty much, have a turnkey solution to create their content, but it's the same content everybody else is using. That's why when you work with Quantum, it's a much different experience. Everything we do is custom and designed to really differentiate you.
So it sounds like the foundation is still in place moving into 2026, but taking advantage of new technologies. Talked about AI, ChatGPT. What are you and the team seeing on the digital side?
The digital side is still, it really depends on who we're working with. So digital is still one of those things where you can waste a lot of money doing digital. But we work with partners who can help advisors who are a fit for it. In many ways, digital is something that is great for branding. We say that all the time about social media. The more content that you create, the more you're sort of priming the pump, so when it comes time to ask for someone to reach out, they're kind of aware of you. But at the same time, again, when you look at digital, if you're thinking about lead generation, it's not a transactional message. You're trying to sell a relationship. We're not selling a car, which I could do easily in digital. All I got to do is give them a price on a car that looks good, but we're selling a relationship. So digital still remains great for branding. In certain cases, it can be appropriate for lead generation if we can talk about a product. A product is great. If you got a 20% bonus and you can talk about it without compliance going crazy, that could certainly work. But digital is still part of our overall planning. It's just still more used for branding.
And finally, I think a lot of the advisors that are on marketing right now with the team, for those that may be considering Quantum, walk us through kind of what that relationship looks like, right? A lot of people say it's too good to be true when we say it's not going to cost you anything for business development, a 24-month business plan. But in order to work with Quantum and get all these accolades, foundations, benefits that you're talking about, what's that look like for those that are considering Quantum right now?
Well, I mean, a long time ago, we decided to really be different. I think of ourselves as sort of the anti-IMO, especially when it comes to marketing, and also with everything that you do on the product side. But most of our competitors look at marketing as something that is, set it and forget it, and it's the same kind of content. What we do is customize everything for the advisor. Now, we do such a broad level of marketing, we commit so many resources to it, we can't work with everybody. So the way that we justify not charging for all that marketing support and branding is to make sure that all we ask is that the advisor is looking to grow, they're engaged, they're responsive, and at some level they're consistently writing business. And we have different, kind of benchmarks here, but we just want to make sure, because we're bonused on everything the advisor does in many ways. As their business grows, we get bonus on it. Doesn't come out of their commission. Everybody on the product side gets that way, especially on the admin side too, but the marketing side for sure. And that's why advisors go, well, that doesn't really make any sense. Well, at any given moment, even though how many advisors or how many firms do we work with? 6,000, 7,000 that are contracted with us at least. We're working with, at any given time, probably 100 to 125, but we're managing 350 custom websites. And then what we're really good at is taking an advisor who has the capacity to grow, to give them the tools to do it. Like, for example, we have 40 radio shows right now across the country. This is an interesting statistic. I went back and started tracking all those shows that have been on the air for at least a year. So I wanted to see what that meant for business. The average premium on an annual basis for a show that's been on for a year is somewhere between 12 and 13 million. So about $1 million a month is coming in.
On the fixed index annuity.
On the fixed index annuity. And in large part, that's coming from the radio show. So what does that tell me? Well, that tells me that radio is highly effective at generating that relationship we're always talking about. And, we're all consultants over here. We're, in one sense, they look at us as salespeople, and in one sense, we certainly are, but we're trying to help advisors grow because that's how we win. We don't win unless you win, and that's why we can, as long as you're someone who is looking to grow and engaged, we can offer you all that support without cost.
Perfect. That's why I think if you're thinking about Quantum, you should definitely give us a call.
That's probably a good idea. Here's an easier thing to do. This time of year, Scottsdale's amazing. Just get your butt out here. We'll take care of you. We'll fly you in. You'll get to see the team and everything, but you'll really see how we are different. Andy, always a pleasure.
Thank you, Scott.
Thanks for watching More Market Insight. We'll see you next time.